Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, OpenAI and AMD strike a multi-billion-dollar deal. We'll bring you the details. Plus, M&A Monday is alive and well as Fifth Third announces a $10.9 billion deal for Comerica. And we break down the market action as stocks look to hit fresh records. All that and more coming up on Market Catalysts. Let's take a look at the major averages to kick things off. We're actually seeing the Dow under some pressure now. It opened higher and then quickly went lower, off by about 220 points at the moment. But the S&P 500 still hanging on to a gain of about 0.1%. And the NASDAQ hit an intraday record. Right now, it's just up about 1/4 to 1/3 of 1%. So we'll see how that plays out. We've seen some more fireworks in other asset classes, notably Bitcoin rising to a record over the weekend, just below 125,000 at the moment, and gold futures above 39.70 at the moment and pushing to a new record as well. And then elsewhere, as we look at what's going on in large cap tech and the reasons behind the NASDAQ outperformance today, has a lot to do with that new agreement between Advanced Micro Devices and OpenAI. AMD up 27% today alone. If you look at the year-to-date chart, we've seen that it's kind of muddled along, particularly in the first half of the year before taking off a little bit. But then obviously this leg higher that we now see today on the back of that deal. Elsewhere, we're seeing a mixed picture. Tesla shares are rising as it teased some kind of new product announcement tomorrow. So we'll be getting a close watch on that. And elsewhere in semiconductors, besides AMD, Nvidia under a little bit of pressure. Of course, it is another major partner of OpenAI, so under some pressure on that. But TSM and some of the other sort of chip infrastructure, chip equipment makers are catching a bid here this morning. AMAT as well, Applied Materials on that list. Well, let's get more on this now. OpenAI and AMD announcing a multi-billion-dollar partnership. Shares of AMD surging on the deal. It's the latest sign of activity in the AI space. It comes just a week after Nvidia invested in OpenAI. Joining me now, Maribel Lopez, research founder who tracks the tech space. Maribel, what's your reaction to this latest news this morning and the sort of broadening of this OpenAI ecosystem?
I think it's great for AMD. I think everybody's noticed that. I think the thing that's really interesting about the space right now is the circular economy flow we're having. It's basically all tides are rising, all of the boats at the moment. They're all investing in each other. They're all committing to large purchases and large capital infrastructure build outs. And I think there was some hesitation in the market for actual dollars being spent on all this CapEx to build these facilities. So now we're starting to see some really creative investment deals between the companies. So this is just the latest in that. What I think is really interesting about this is it's really actually picking up on something that not too many people have talked about, and that's that enterprises are starting to move into AI. When they do that, they're looking at inferencing technology. AMD is really good right now at inferencing technology, and OpenAI has made an investment in that. So we've got a high end to the GPU market and a mid to the low end in the GPU market. And really OpenAI has basically placed bets so that they can service all the demand that's going to come moving forward with a combination of NVIDIA and AMD, and keeping NVIDIA a bit honest, I might add.
Yeah, I mean, so it doesn't sound like this is necessarily negative for NVIDIA then.
No, absolutely not. I mean, frankly, NVIDIA will continue to sell everything that they produce for the coming several years. So I'm not really worried about NVIDIA. Where I think the worry comes in the longer term picture is that NVIDIA can't just sell at the high end of the chip market. It's going to have to sell at a broader end of the stack. It's going to have to win inferencing workloads. We originally thought those inferencing workloads were going to go to Intel, then that became suspect. We then moved into thinking about AMD, but also we have platforms for NVIDIA that are good for inferencing as well. So the question is, will AMD eat into what we thought would have been that upside for NVIDIA? And there's a good chance that at least people are investing to make sure that they have a solid alternative to NVIDIA on that market.
So, Maribel, does this mean for investors that you just kind of buy everything, right? If you have this rising tide idea, I mean, on the flip side, you can just buy the S&P 500 or the NASDAQ 100 because they also include all of this stuff. Like, how choosy do you need to be as an investor?
So I think it's very difficult if you're coming into the space right now to see a tremendous upside for these AI stocks. They've had a tremendous run up. It seems like almost every day there's a big deal. There's, I think the surprise winner in this has been someone like Oracle, who did see quite a bump. Of course, that's come down a bit, but even still, Oracle had not been sexy for a while. So this just goes to show that AI can make anybody sexy at this point. So one of the things we're seeing is, I think you have to be very cautious if you were coming into the market now. If you're already in and you have positions, you can hold, because there is still tremendous growth and upside that we have yet to see in this market. I will say, if I look out 2 quarters from now, I think next quarter's fine. I think we're still going to continue to see growth. I think at the slightest hiccup that we see in this market, people will run for the hills because they'll feel that the stocks that they're looking at are extremely overvalued. So I would actually be thinking about bets that might be a little more long-term, but still have some upside. One of the things Nvidia has been talking a lot about is this move to physical AI. We have not actually seen that yet. There's a lot of momentum that could be in industrial, it could be in the edge use cases of AI. So people that are building chips, that if you're looking at the chip market, that would go into smaller form factors that would be seen out at the edge in a store, in a manufacturing plant, those kinds of things.
Maribel, give me some more sort of concrete examples of that. So if you're looking for those industrial cases, the so-called physical AI, what kind of companies are sort of participating more on that side of things?
So if you look at somebody that's well established, for example, but could still do very well in that space, you'd be looking at a Qualcomm. You could be looking at a Broadcom. You could be looking at some of the Chinese AI chip companies, which will not necessarily meet the price performance window of Nvidia, but could be very good in a whole other range of use cases. So Cambricon, for example. So there's a wide range to look at here, but I think I would be looking at markets that still have a good growth opportunity. They have a use case, but they have yet to deploy. So we were actually talking to quick service restaurants that are now building edge AI. They're actually putting AI in their quick service restaurants. People are putting AI in their stores. So that leads to some of the smaller footprint use cases. But honestly, right now, it's who knows.
Yeah.
Could be anything.
Well, and it also sounds like, though, this potential hiccup that you're anticipating, and usually these things are inevitable in markets, that you get that kind of occasional volatility, especially with something that is an expanding, innovative industry like this. It sounds like you would sort of batten down the hatches and hold on. Like, in other words, when that panic hits, you're not going to be participating in that panic.
I think everybody has to make their own call on this one, and it really depends on what you bought in at, right? So this market, if you look at the fundamentals of the market, there will be growth. It will come in patchy growth. No growth is perpetually linear up and to the right. So I do think we're going to see some of these little step functions. And as a result of that, you have to say, is this something that you want to keep for the long run, or are you trying to be opportunistic? If you're opportunistic at this point, these chips seem to be at an all-time high. They could have a few more clicks in them. But having said that, it's what's your risk tolerance?
Yes, good precision there, because people have a wide swath of risk tolerance, to be sure. Maribel, thank you so much. Appreciate it. Coming up, we'll take a deep dive into OpenAI's journey to its $500 billion valuation. Plus, an expert tells us why more companies choose to remain private. That's next on Market Catalysts. OpenAI is now the largest private company in the world, with a valuation of $500 billion. How did it get here? Well, OpenAI first gained mass notoriety in November 2022 with the launch of ChatGPT. The research tool gaining 1 million users in its first week alone, it ignited the widespread public interest in generative AI that we see today. Since then, OpenAI's growth has ballooned, becoming the go-to search engine for 24% of Americans in just a few short years. That's according to an Adobe survey. Joining me now to discuss the future for OpenAI after hitting this $500 billion milestone is Kyle Stanford, PitchBook Director of Research for U.S. Venture Capital. Kyle, it's good to see you.
Good to see you too.
So it has been an amazing journey that we have seen for OpenAI, and the valuation is obviously eye-popping here. What do you think is sort of the OpenAI special sauce within the fundraising world that has allowed it to just keep, generating this kind of fundraising for itself?
I mean, you kind of look everywhere and it's all really hot, right? Their revenues for the first 6 months of this year were higher than 2024. They've got partnerships with Nvidia, AMD, Oracle, Microsoft, Apple. They've got, they were kind of first to market. So kind of everywhere you look, there's a high reason for these investors to, have want to put money into here. So like, I don't know if there's a singular secret sauce that OpenAI has, but all of those together just really make it an interesting company.
Yeah, I mean, I guess the secret sauce isn't so secret, right? Because we all see it in terms of the adoption of ChatGPT. What I find interesting, Kyle, is that, certainly when we talk to people, even people who are AI bulls who invest in it, they do share some of these concerns about the so-called circular economy, right? And the Nvidia investing in OpenAI, which is using some of that money to buy Nvidia chips, et cetera. Has that had any kind of effect on its fundraising ability?
You wouldn't be able to tell it if it has, right? If it's jumping from 100 to 300 to 500 in consecutive years and raising $40 billion from investors and secondaries going up at, $6.5 billion, every 6 months or so, like if there is any hesitation because of the circular economy, you're not seeing it in the fundraising.
The other issue that has been sort of dogging OpenAI for a while now is this separation that it has been attempting to do or is going to attempt to do between its nonprofit and for-profit arms. That has faced some legal challenges. Is there any chatter on that in the fundraising world and what that's going to mean for the company going forward?
I mean, I think it's really tough to have too much chatter on that until you kind of, get the full run out of what's going to happen, right? Obviously, if it has to stay a nonprofit, that's going to be very difficult. But the way it's moving and the way it's partnering with all these big tech companies, it's tough to think that there's any more hesitation because of that either, right? Obviously, that got a lot of talk when Elon Musk was diving into setting up challenges for Sam Altman and OpenAI. But there hasn't been too much talk about that specifically over the past few months.
Kyle, you've been covering this world for a while. How anxious do investors get to exit, right? And what would an exit look like for OpenAI? And at some point, what does that cycle tend to look like?
I think OpenAI is going to be very different than every other company we've seen go through the kind of venture life cycle, right? You're at $500 billion. You have ample amount of private capital waiting to take secondary shares, so you can get employees, early investors, the liquidity they're looking for. You have no real reason to go public now with the growth that they're seeing in the private markets. Like going public is going to add a little more cost and a little more hurdles to get through when they're just trying to operate and kind of really charge forward with their revenue growth. So I don't see an exit necessarily, like a traditional exit from an IPO, or obviously not an M&A is going to happen. But an IPO is not going to happen in the next year or two for OpenAI, right? Until you start to see that private market capital dry up for this company specifically, there's no reason for them to go into the public markets.
Are they going to be under any pressure to go profitable anytime soon, Kyle?
I don't actually know that they would be able to go profitable in the near term, right? When you look at the cost and the way that that's grown too, they blew their cash burn rate was about $2 billion through the first 6 months of the year. They're looking for $6 billion in total burn in 2025. That's not something that they would be looking to just cut and completely change their business model, right? They need that money to be put to work. They need it to continue growing, to be bringing out new models, to reaching new customers, to creating new inroads for enterprises into their business. So they're not going to be cutting that burn anytime soon. So I don't see this becoming a profitable company.
Go ahead, Kyle. What were you going to say?
Oh, I was just going to say, obviously, the energy costs are another thing, right? If you're spending a lot of money to run all of these chips and all the energy that's taking, without energy prices coming down, they're going to have a huge cost in that category, too.
And the final thing I wanted to ask you, Kyle, is with so much capital going to OpenAI, are we seeing other companies kind of be starved of capital and having trouble fundraising because so much is going in this one direction?
I don't think it's because of OpenAI, right? And when we look at the startup market, it's really kind of two different markets, all of AI and the rest, right? When you look at who's investing in OpenAI, it's Dragoneer, it's Thrive, it's SoftBank. Like those are firms that are not short on capital and are able to get capital in different areas than just the dry powder in their VC funds, right? So I think when you look at the rest of the market, though, if you are not an AI native company or haven't integrated AI into your business model, it's a really challenging environment to raise. So it's not going to be one single company that is taking a lot of the money from startups right now, but AI in general is having kind of like a 2021 looking chart up into the right every year, new deal count or new record deal count, new record deal value. That is taking money away from the non-AI companies who are unable to kind of create that revenue growth that they might have seen up through 2021.
Thanks, Kyle. Appreciate it.
Of course, thank you.
Well, despite recent strength in the IPO market, more and more companies are choosing to stay private for longer, including OpenAI. We spoke with OpenAI CFO Sarah Fryer to ask about the company's plans for a public offering.
To me, an IPO is just another form of a fundraise. So will we still be fundraising to keep funding compute? I suspect the answer to that is yes. And so right now we need money to invest in compute, money to invest in great researchers, and we need to keep bringing customers along by showing them value, whether it's enterprise customers all the way through to small businesses, to consumers.
And as we just heard from Kyle Stanford, he doesn't think it's going to happen anytime soon. Let's talk more about the state of private markets. We're joined by Eric Hirsch, co-CEO of Hamilton Lane, which is a global investment firm focused on private markets, including private equity, credit, real estate, and infrastructure, with $986 billion in assets under management and supervision. Eric, it's good to see you. It's an interesting moment, isn't it, as we have been talking about this private fundraising that has happened for the likes of OpenAI, but of course not just OpenAI. What do you make of it? And through your career, how has this kind of changed? What has been the real reason that so many companies are getting so large on the private side?
Julie, always good to be with you.
You too.
I think what you're seeing is this is a sort of typical maturation and an evolution, which is if we go back a couple of decades, people wanted to be public. That was the hallmark, that was the stamp of success. That told your customers and your competitors that you had made it. That's no longer true today. So today, the number of public companies has generally been trending down and to the right for the last several decades, and there's a few reasons for that. It's expensive, time-consuming, and all of that to be a public company. I know, we are one. But it's also the fact that the private markets have continued to develop, mature, and grow to a point where there's adequate capital to allow you to stay private for as long as you want to.
And do you see any kind of change to that equation?
I don't. I think, frankly, this is just giving choice to the market. If you want to be public, and by the way, again, we made that strategic decision several years ago because we saw some real strategic advantages for Hamilton Lane to be public. But if you don't see those advantages, or you frankly see more advantage in being private and having private capital, private partners helping you grow, then you've got the optionality to do that. I think this is a good thing. It's not a great thing for the public markets because, again, there's just less choice going over there. But I think it's a good thing for companies to be able to chart their own path depending on which one makes the most sense for them.
Well, and it's also maybe one of the things that is less good is that, you know, most investors, the vast majority of investors, don't have access to the private markets, right? They can't invest in OpenAI. That maybe seems to be changing a little bit. Do you think it is going to change, and how quickly is that going to happen?
So I agree with you that that has been a real downside for individual investors. If you're not part of a pension plan where those, frankly, a lot of those returns are coming from the private markets, you've basically been left out and left behind. That is changing. So with the advent of a series of products referred to commonly as evergreen funds, private markets are now being much more accessible to the mass affluent. That's still not everybody, but it's a big step forward for people with a couple $1 million net worth, and there's a lot of those people, as we know, in the United States, but that is happening now. And if you look at the exposure for that customer base, it's basically 0%, but the change is here, the change is coming, and I think it's going to occur very rapidly. The next question then tends to be, do you think we're going to get that private market access moved into the 401k market? And I think that's a different question.
What's your answer to that question, Eric?
I think we will eventually, but I think we're going to see more. We need more than simply an executive order or the administration saying, hey, let's make this happen. I think you're going to see real regulatory reform required in order for that to happen in a way that makes sense for the consumer of that product and the provider of that product.
I want to switch gears and just ask you as well about something that's been going on in the news, and that's the government shutdown. Because I know it's something you're watching, but I'm curious specifically. We've had the IPO window finally open back up. A number of IPOs that allows exits for firms like yours and stuff you've invested in. With the SEC, presumably on furlough like everybody else, does that run the risk of sort of slowing down that momentum?
I think this is a question of duration. My own view is that we're going to see this likely get resolved this week. But if I'm wrong and this stretches for weeks or longer, then I think you're going to see ripple effect. I think right now the market is telling you that they also believe this is going to get wrapped up and resolved in relatively near term. But again, if that proves to be incorrect as we sort of see what happens or doesn't happen this week, then I think you are going to see ripple effects, not just simply from the SEC, but we're going to start to see some ripple effects across other broader parts of the economy.
So I guess then, all things being equal, let's say the shutdown is short. Do you think that the IPO window is, that things are now sort of open for business again? And what does that mean for exits in your business?
Well, I think it does mean that you're open for business. If you look at how recent IPOs have traded, generally have been trading very strong. I think part of that is this sort of pent-up demand of the market is looking for more diversity and more product. If you're a primary public market investor, you are dealing with an equity concentration, market cap concentration, the likes of which we haven't seen in recent history. And so you've got a small number of stocks driving the performance of the indices. And I think investors are smartly looking to try to get more diversity in their portfolios. And I think that's been a big reason why you've seen strong performance. And once you see strong performance of recent IPOs, what does that result in? It tends to result in more IPOs.
Right.
That's a good thing for the markets. It's a good thing for the private markets who are using that as an exit environment. So I think all of that is a positive trend.
Eric, great stuff. Thank you so much for your perspective. Appreciate it.
Great to see you, Julie.
And for more private market data, you can head to Yahoo Finance or scan the QR code below to track private markets, including valuations, fundraising, and more. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. First up, Micron, the chip maker getting a boost after Morgan Stanley upgraded the stock to overweight from equal weight, citing a multi-quarter stretch of double-digit price increases. Analyst Joseph Moore is saying Micron is, quote, pushing the envelope on valuation, but does see price gains translating to substantially higher earnings power. He adds this pricing upturn should resolve any lingering questions around Micron's high bandwidth memory chips and set a $220 price target, signaling about 12% upside from current trading levels. Next up, Klarna. Wedbush initiating coverage of the buy now, pay later giant with an outperform rating and $50 price target. Analyst Scott Devitt calls Klarna a tech-enabled bank at the center of the commerce ecosystem with strong exposure to alternative payments, AI-driven underwriting, and digital wallet growth. Wedbush expects sales to climb about 20% a year through 2028, with profits growing even faster as new markets mature. The firm also highlighted Klarna's AI partnership with OpenAI, which now handles nearly 70% of customer service chats, one of the reasons they view the company as leveraging AI for both efficiency and scale. And finally, Shake Shack under pressure after Bank of America cut the stock to underperform, warning that margin pressures from rising beef costs and elevated competition could weigh on results. The downgrade also flagged that Shake Shack's plan to grow to 1,500 domestic store locations could be too ambitious, calling out saturation risks outside high-income markets like New York. BofA also lowered its price target on shares to 86 from the prior 148, citing a tough consumer backdrop and price-sensitive diners. We'll keep it right here on Yahoo Finance while we'll be tracking all the market moves throughout the session.
It's a big M&A Monday with the largest bank deal since 2023. Cincinnati-based Fifth Third will buy Dallas-based Comerica for $10.9 billion. It creates a bank with about $288 billion in assets. Joining us for more, our banking reporter, David Hollerith. Good to see you, David.
Hey.
So what do each of the banks get out of this deal?
Yeah, for Fifth Third, it means that their expansion efforts in the Southeast and Southwest is going to be turbocharged essentially by Comerica, which is a Texas-based bank's commercial division. They have like a very large traditional banking commercial business, which is heavily sought after, even by the country's largest banks. And so really for both banks, it's a big question around scale. Ever since the 2023, we call it the mini regional banking crisis, regional banks have been they've seen sort of the disadvantages to their size, being bigger than community banks in a certain way, and then also being much smaller than the mega banks. So they both have a need to grow. Comerica in particular, their stock and performance, their earnings performance has lagged peers for over a decade. And more recently, there's actually been activist attention on the bank. Holdco Asset Management published this 52-page, pretty critical report back in July, and their consensus was they'd taken a 1.8% ownership of common shares of Comerica, and they were urging Comerica to sell itself. And they were even taking steps to do a proxy battle early next year, or I guess that would kick off in December. But so there's plenty of pressure on Comerica. In general, there was some pressure on regional banks in terms of their stock performance relative to the bigger peers.
Right.
And Fifth Third is an acquirer bank. They're pretty strong. They have a very strong Midwest presence, and they're trying to grow in the hot markets, which have been the Southeast and Southwest for a while.
And so when you talk about this sort of in-between place that the regionals are in, bigger than the community banks, smaller than the mega banks like the Cities and Bank of Americas and JP Morgan, what does this increased scale, sort of do for them? How does it help them to better compete?
Yeah, well, for Comerica, it's a big deal because they didn't really have a retail franchise. And retail deposits are known as being some of the stickiest in banking. And so it's a lot more stability for them. For Fifth Third, it means that they have more scale, more ability to make loans using their deposit base and to expand into commercial banking, which is, they call it like C&I lending. That's kind of the hottest.
Commercial and industrial, right?
Yes,
Yeah.
yes. It's one of the hottest places for traditional banking in the U.S. So.
And we also are at a moment where rates are coming down, right? So does that, I guess for banks, it creates both vulnerabilities and opportunities, particularly at that level where they don't have, for example, a big trading operation to offset some of that.
Sure, yeah. Interest rates coming down are generally seen to be good for regional banks that have, these bigger mortgage operations and the commercial real estate and also C&I lending.
So they could see more demand as rates come down.
Exactly. Whereas bigger banks are typically seen to be more asset sensitive, meaning that they benefit from higher interest rates because they get thicker margins. Really, to cut it, it's hard to know between any one bank how interest rates are going to affect them, and it all kind of depends on how things fare as interest rates begin to cut. So
yeah, and then finally, I'm also curious about the regulatory environment that allows a deal like this to happen, right? Because we don't see big banking deals that often. Is the regulatory environment more friendly to this kind of stuff right now?
Absolutely. I was speaking to this guy who's known as basically the Wall Street banking surgeon. He's done a lot of distressed deals in the past. And he had said to me last week that effectively this is the most favorable environment he's seen in a very long time, especially compared to the Biden administration in terms of their bank merger policy. And you can't help but read through the fact that since 2023, there's some need for that, even no matter what side of the political aisle you sit on, that banks for a while have needed to merge to compete with the mega lenders.
Dave, thanks so much. Really appreciate your reporting on this, and fun to talk about a deal this morning.
Absolutely.
Thanks. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves to your portfolio. I'm here today with Ben Connard, Carnegie Investment Counsel Portfolio Manager. Ben, it is great to see you. So we're going to start off on a name you like, Ben, and that would be Microsoft, which has had a good run already, Ben. It's up about 25% year to date. Most analysts on the street, they still like this one. You do too. So let's walk through some of the reasons why. The first reason, Microsoft 365 commercial revenue.
Sure. Microsoft has a huge base. They've got about 400 million commercial users. That provides a steady source of revenue for the company. It's pretty economically resistant. It's not going to move much. And it provides a steady cash flow for them that they can invest other places in their business.
Second point, Ben. Second reason you say this one's about set up to monetize AI.
Yeah, it's actually related to the first point. With all those users, they can add their co-pilot to that, their AI agent, and they can upsell those commercial users the co-pilot. They charge more for it. They almost double the revenue per user, and so that's a big source. And then they have Copilot in GitHub, which is their software development program, and that's grown quite nicely. They're about 20 million GitHub users using the GitHub Copilot, and so it's a nice added revenue. And they're one of the few companies that are already monetizing AI.
And a third reason you'd commit capital to Microsoft, Azure cloud growth.
Yeah, Azure is their cloud infrastructure product. It's growing nicely. I think it grew 39% year over year last quarter. They are obviously providing the infrastructure the data centers need to run AI. They obviously have a relationship with OpenAI, and that's leading to steady growth. And then just in general, we still have tech companies moving their technology from on-premise to the cloud. And since Microsoft has an established relationship with a lot of companies through their legacy server business, that provides an easy guide. Be like, using us now, let's transition to the cloud.
All right, finally, Ben, before you all pile in, let's talk about some downside risks. Cloud business has lower margins. Walk us through that.
Yeah, in general, the cloud business has lower gross margins than their other businesses. And it's also their fastest growing business. So if you just think about that, that's going to lower their overall margins. And then the cloud business is very competitive, and it's becoming increasingly competitive with Oracle. So you already have Amazon Web Services, you have Google Cloud, and now Oracle Cloud has joined, and they're growing exceptionally well. And that competition means their margins aren't likely going higher, and that'll impact Microsoft going forward.
Let me ask you, when you look at a name like Microsoft, basically everybody likes Microsoft. 97% of analysts who are paid to give you an opinion about Microsoft, 97% have a buy. Does that ever give you any cause for concern when you see a name and basically everybody is piled on one side of the boat?
Yeah, it is. And I mean, you see it in the valuation. Microsoft's not a cheap stock right now. It's over a 30 times multiple. But to us, it's still a core holding, and it should be in your portfolio. And there's still those businesses, the lines we just talked about, provide downside protection and say, yeah, let's keep owning this stock, or let's buy it.
All right, so that's one you like. Let's now talk about one you don't like as much, you'd avoid. That would be Adobe. Now, this stock is already down. It's down about 20% year to date. You don't see that as an opportunity. You would still avoid Adobe. So the first reason is competition.
Yeah, so Canva and Figma, they've been around for more than 10 years. This isn't really new competition, but it's increasing competition as Adobe expands beyond professionals into non-professionals. They're running into Canva more, and so it's just something to be wary of, and the competitive landscape has changed for Adobe.
Second reason you say avoid Adobe. AI native products also a source of competition.
Yeah, OpenAI has a product. Google has some AI products that help video editing, image editing, and that's added competition. And again, it's for the non-professional users, but it erodes Adobe's ability to grow users quickly.
Finally, reason you steer clear, pricing power threats.
Yeah, it's obviously connected. Adobe, they grow revenue through more users and also increasing their revenue per user. And that is, they have the pricing power to basically increase prices. And when you have more competition, you don't have that power, and then it's going to make it harder for the company just to grow the top line.
All right, so you say avoid Adobe, but finally, Ben, walk through, how could you be wrong on this call?
Right there, Adobe, it's still the marketing standard for professionals. So they have a base that's not going to be dislodged. For a lot of professionals in the marketing space, it's part of their workflow using the Adobe products. So it's not like companies can just sweep in and take that business away. And as the chart you just showed, the stock's been hit. It's priced pretty cheaply, but ultimately we think that there's still downside because the competition is too great with the Canva Figma and then the new competition from native AI.
All right, so buy Microsoft, avoid Adobe. Ben, thanks so much for your time today and those picks. Appreciate it.
AI has touched nearly all corners of the nation's economy and labor force, or at least talk about it has. And it's gotten a bad rap for displacing large numbers of workers. But are those accusations rooted in fact? Joining me now, Martha Gimbel, director and co-founder of Yale University's Budget Lab, which recently did a deep dive into the effects of AI on the workforce. Martha, thanks for being here. Obviously, this is a very hot topic. A lot of people are concerned that even if it's not having an effect now, that it soon could have. So how did you go about trying to quantify the effect that AI is having on the workforce?
So we did it a couple of different ways. One, we went and took measures from the labs themselves, OpenAI and Anthropic, around how exposed certain workers are to AI or how much usage certain occupations are seeing of AI, and looked at whether or not those workers with more exposure or more usage were seeing a decline in employment or longer durations of unemployment. Spoiler alert, they weren't. And then we tried to take a really agnostic perspective on this and just look at how rapidly the occupational mix is changing in the United States. How fast is the labor market changing? Is it really the case that we're seeing this kind of unprecedented disruption to the US labor market? And it's not. Frankly, if you look at the occupational mix, yes, it's changing a little bit faster than it has in past periods of technological change. But that speed up actually predates AI. It's much more likely to be related to the aging of the population, changes in immigration, et cetera. I do want to emphasize this is not to say that there won't be impacts in the future. That's why my team is planning on updating this every month when we get the data. But I think it's really, really important for this conversation to be really data-driven as opposed to being led by our emotions.
And one of the things that you also did was compare this technological wave to other sort of innovation cycles in the past, right? So I know you looked at, the sort of advent of computers and popularization of them going back to 1984. You looked to the internet back in January of 1986, and kind of what does the arc of those prior cycles show compared to what we're seeing now?
So, frankly, right now, it's looking pretty similar to those past eras of technological change. Again, that could change at any time. I think it's important to keep in mind, we still don't know where this technology is going. It's still early days, but we have weathered periods of technological change before. And so I think it's a little bit early to be going into full panic mode about the impacts of this technology on the labor market. We still need to see where we're headed.
To your point, obviously you want to be data-driven and not rely on anecdata, right? Which, a lot of us are exposed to. But I certainly have heard examples of companies saying, well, before at an entry level, I would hire 10 people. Now I'm hiring 5 people because they're more productive as a result of AI. Where would that be showing up in the data if it was happening at scale?
So one thing I do want to say is I think it is really important to, yes, listen to what people are saying, but not necessarily take it at face value, right? There are many reasons why people can be having layoffs or slowing hiring. We have an overall slowing economy. It is not surprising that firms are hiring less than they were a year or two ago, given the broader macroeconomic conditions. But there's not necessarily a social return to saying I'm hiring fewer people because the macroeconomic environment is hard. It sounds much better to say that it's because of AI and you're making these productivity enhancing investments. That's not to say that that's not playing a role. It's not to say that people aren't doing that. It is simply to say that, it is very easy to say that your hiring changes are due to AI. But if we look at the data, that's not yet what we're seeing more broadly. There are some very, very specific areas in the labor market that do look like they've been impacted by AI, particularly very young programmers. But we don't know how hiring in that sector will evolve moving forward. And we don't know whether those impacts will spread to the rest of the economy over time.
Well, and that was going to be another question, Martha, which is that, again, there's sort of this conventional wisdom or chatter out there that, there are certain areas of the economy that are going to be much more resistant to an AI effect. But what is, again, going back to the data, what are you seeing in the numbers at this point?
At this point, we're really not seeing big differences among employment, whether you're highly exposed to AI, slightly exposed to AI, or really not that exposed to AI at all. I think one of my big takeaways from writing this paper is if you look at periods of really big change in the labor market and really fast change in our history, it wasn't even due to technological change. It's due to really big demographic shifts, like, for instance, the end of World War II, or the mobilization after World War I. And I think that speaks to the fact that this technology, AI in particular, feels really, really fast, really, really sudden. But it takes time, one, for technologies to fully develop, for firms to fully realize how they can make the best use of them, and then for firms to adjust what hiring and their overall worker mix looks like in response to that. And so, I think AI feels very fast, it feels very sudden, but we need to really remember that it takes time for economies to adjust to technological change, and it's not going to happen overnight.
Martha, it sounds like we need to keep in touch as you get more and more of this data, and we'll continue to talk about it. Thank you so much.
Thank you for having me.
Appreciate it. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, we'll have full market coverage ahead as AMD's surge lifts tech stocks. And with the government shutdown entering its sixth day, we'll look at when we'll actually start to see the impacts. And a big deal in the banking space will hone in on deregulation in the sector as Fifth Third buys Comerica. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. As we look at the major averages, we do see a mixed picture here. The Dow under some pressure. It's down more than 100 points at the moment, but the S&P 500 up 0.25%, and the Nasdaq touched a new intraday record today, up by 0.4%, helped in part by, of course, the tech sector. By the way, the Russell 2000 of small caps also touching a record today. Government shutdown dragging on for its sixth day as lawmakers remain at an impasse over funding bills. Joining me now, Washington correspondent Ben Werschel, as well as Wendy Elberg, Brookings Institution Senior Fellow in Economic Studies. Ben, let's start with you. Where are we today? Any votes scheduled? Any kind of movement here?
Yeah, well, we have votes. I don't know if I'd go so far as having movement there yet. We have another round of votes set in the Senate at starting at 5:30 p.m. This is a vote on a Democratic and a GOP plan to end the shutdown. I will note this is take 5 at trying to get these over the 60-vote threshold. We've had 4 failures so far. The widespread expectation here is that we're going to go 0 for 5 this evening when senators return here. And the signals we're getting here in Washington is that this kind of Groundhog Day approach to shutdown of repeating the same votes over and over again will continue. Both sides are really dug in, and the Senate is likely to vote, assuming they fail today, on Tuesday and then again on Thursday on these GOP plans. So the most live one is a GOP plan that would keep the Senate or the government open for 7 weeks, and basically the try to pressure moderate Democrats to just accept that plan and go further. Beyond that, there's questions about sort of if and when the teams will negotiate. The Democratic message here is that we're not folding. Moderate Democrats are unified with everyone else in their party, and that they're going to force Republicans to the negotiating table, especially over these Obamacare subsidies. That's the kind of front and center issue here, these subsidies that expire at the end of the year, and whether Democrats can hold out long enough to force Republicans to negotiate on there. Mike Johnson, just the last hour, defended the fact that the House of Representatives isn't even in town this week. He said there's nothing to negotiate. He said he wants to talk about this healthcare issue, but that's for another week. Democrats just need to accept the GOP plan for now. So that we're expecting kind of another week of standoff.
So, Wendy, if this is going on for at least another week, I think what we're all trying to grapple with here is, as we're told there are various economic impacts, how does that unfold sort of day by day? The conventional wisdom is the longer it lasts, the worse it is. But we're trying to get a little more granular on how that works.
If you think about some of the things that the federal government is not doing for us now, so we're not getting really important economic data releases. So the Federal Reserve and anybody trying to understand what's happening in the economy, they're flying blind right now. But if you're suing someone in federal court, you're probably seeing that you can't that you can't make any progress. You're probably no longer making progress on federal permits that you're trying to get. In a certain, in a matter of days, nutrition assistance funding will run out, and nutrition assistance will not go out. So there are a bunch of avenues through which this really affects people. But I gotta say, the reason that this is a terrible idea to shut down the federal government is not because of the near-term economic effects. It's because broadly, this just adds to the environment of chaos.
Well, this has been going on now. We've sort of become accustomed to this situation happening more and more, Wendy. And everybody who comes on the show, I say, well, how do you stop it? And there's no good answer for that, is there?
I could not possibly be the person to explain how to bring some method to the madness of what's happened with budget negotiations and political negotiations on the Hill. These two sides basically have no way to credibly negotiate with each other, because if the Democrats try to negotiate for an appropriations package, how can they possibly have any assurance that the president will actually fund the appropriations that have been written into law? So there's just not a lot of trust on either side. This can't go on indefinitely, though, in the current state of affairs, because right now people in the military are working with no assurance that they will get their next paycheck. They will ultimately get back pay, but in about 10 days, a date will come and go when they would have normally gotten their paychecks, and I am guessing that Congress needs to do something before then.
Well, and Wendy, in the other instance that you mentioned, where basically SNAP benefits are not going to be going out, so, those folks, it's not like you can sort of make up for what you haven't eaten today by eating more tomorrow, right? It's not like pay where you get it eventually. So what happens in these situations? Do nonprofits step in? Do they have that ability? How does this tend to play out?
Oh, for sure. If this goes on long enough, this becomes an economic nightmare for the families and federal workers that are not getting the payments that they expected, that are not getting the paychecks that they expected. Federal contractors don't get paid. So for those families, this is an absolute nightmare. Certainly we saw in prior shutdowns, generally speaking, the effects on the aggregate economy are relatively modest, but certainly for those families, it would be a complete disaster.
Let's talk about the other wild card here, Ben, and that is the threat that some of these furloughs will become layoffs, will become permanent. Again, it is just a threat at this point from the administration. What should we be watching to see if that threat becomes reality?
Yeah, this has been the big X factor of this shutdown, in the sense that of this threat that you mentioned from President Trump. He's promised that to not only enact mass firings, but cut programs. He's called them Democrat programs that he wants to get rid of completely, calling these irreversible cuts that he has planned. The issue, as you alluded to, is we haven't seen any specifics here. We've seen some specific money that's been held off, kind of by tweet from Trump's budget chief, but this promise of layoffs, kind of, that you hear a different timeline depending on which administration official you're listening to. Last week it was going to happen in 1 to 2 days. We haven't had any specifics there. Some comments from Trump's top economic advisor over the weekend suggested kind of a week timeline here. J.D. Vance has offered a similar thing. So this is clearly going to up these kind of economic effects we're watching for. As Wendy laid out, these economic impacts could progress slowly if this plays out like other shutdowns, but this is what could change it. At the moment, Democrats promise that this is kind of an intimidation tactic. There's even a lawsuit to stop Trump's efforts to enact firings here. But if he tries to move forward, and especially if he succeeds, that's when we could kind of see the economic levers change a lot based on previous shutdowns.
Yeah, Wendy, talk to me about this part of this aspect of this and how the calculation would change and how then you estimate the sort of economic impact.
Yeah, this is exactly the kind of thing I had in mind when I said that this is adding to the chaos in the current economic environment. The news to federal workers that the federal government is not a good actor as an employer would not be news to them right now. The Trump administration and cabinet secretaries have made it clear on a number of different fronts that if you're a federal employee, you really don't have a productive, stable employment situation. And that's a situation that leads to worsening productivity. It means that every federal worker is probably job hunting. But that was true before this past week, and it will only be more so true now. What the irony here is that the people who are making these threats about doing these mass layoffs will do, I think, have the effect that I just laid out, which is it will make productivity of federal workers worse, and it will make it harder for people to interact with the federal government efficiently. And the irony is that that's going to lead more people throughout the public to be frustrated with the services they get from the federal government. But that lack of productivity will have been precisely engineered by these sorts of actions being taken, on the part of the Trump administration.
Yeah, it can't be good for recruiting of talented folks.
Oh gosh, no. And if you were thinking that you were a contractor and you wanted to have a contract with the federal government, this is absolutely the kind of thing that makes you think twice.
Yeah, I can imagine. Wendy, Ben, thank you so much. Appreciate it. We got much more markets action coming up. You're watching Market Catalysts. President Trump is considering $10 billion in aid for American farmers amid the ongoing trade war as soybean farmers take a hit from China refusing to buy the crop. Overall, new sales of soybeans down 81% this year compared to the 5-year average, with other countries not making up the difference of the shortfall caused by China. Joining me now, Caleb Ragland, American Soybean Association president and, of course, a soybean farmer himself. Caleb, it's been a minute since we had a chance to talk. So we appreciate you joining us. What's going on? Where are your soybeans right now? Are they just sort of sitting in silos, waiting to be shipped to whoever's going to buy them?
We have a great supply of soybeans that are ready for customers. And historically, China is a large purchaser of our soybeans. They're the largest export customer in recent years, and they have been buying about 25% of the whole U.S. crop in recent years. Unfortunately, they have not purchased any soybeans out of the crop that is currently being harvested. No purchases have been made since May, and none are on the books for future months. And this is a five-alarm fire for our industry. China purchases more soybeans than all of our other current export customers combined. And with them not entering the market, it is very concerning for the future of our industry. We export about half of all the soybeans that we produce in this country, and China purchases more than all other customers combined. So they consume 61% of all soybeans consumed worldwide. So they're a major market and not a market that we just flip a switch and replace. And we need our presidential administration to be working hard to get this market back. It's obviously a complicated political situation, but the Chinese market is vital for agriculture in this country. Soybeans are the largest ag export that we make as a country.
Right.
China is our biggest customer, so they are a vital part of the business that we do and a big part of the economy of rural America.
Caleb, talk to me about what happens in the meantime. You said you're harvesting right now. Obviously, different crops can keep for different amounts. In the case of soybeans, once you get them off the plant, what happens to them, and how long can they sit around before you need to move the crop?
The soybeans are stored dry, and they can last for several months in storage. The biggest issue is the American farmers need cash flow. They need income. This is the payday that they have, is they've invested in all the expenses of growing the crop and getting it ready for market. And once it's ready to sell, they need that income so that they can pay their bills, so they can feed their families and take care of all the other financial obligations that they have. And that is a bigger issue than the shelf life of the soybeans. But while that is a concern, the main issue is American soybean farmers need cash flow. We need good markets, and we need economic opportunity. And right now, that is really a challenge.
And, you know, this aid package that is being talked about, does that at least help sort of bridge that cash flow gap?
The aid package that's being discussed is not something that American soybean farmers are rallying for necessarily. It is a last-ditch effort to help plug a hole of an economic shortfall that we are experiencing as an industry. What we need long term is strong markets and competition for the products we're producing. We want to make a profit from the market. We need competition for our soybeans. Unfortunately, there's not enough market competition taking place right now due to the trade war we're in, and this package that's being proposed is a short-term stopgap measure. But this is really just putting a Band-Aid on an open wound. We are bleeding economically. We're losing a lot of money. Our economist at the American Soybean Association says that we're going to lose $109 per acre on every acre that's produced in soybeans in this country this year. On 83.4 million acres, that is a lot of money being lost. And what we need is competition. We need a level playing field, and we get that by not having tariffs that are in place and the retaliatory tariffs that result. And we need to be able to compete fairly with the competitors from around the world.
Right.
Brazil is our largest competitor. And right now they're kicking our tail because they have about a 20% price advantage in the Chinese market. And we can see an example what happened here recently with the Argentina holiday that was taken on when they put the tax at the export tax, when they did the tax holiday and they had a level playing field. The Chinese came into the Argentina market and purchased immediately because the price was competitive once again. We would see the same thing happen with our soybeans if we had a level playing field and didn't have a 20% retaliatory tariff in place that the Chinese have levied.
Caleb, I'm curious though, if China has now turned to Brazil and other markets for its supply of soybeans, even if the trade war ends, what gives you the confidence that they're going to come back to the U.S. as a customer if they're getting the supply they need elsewhere?
That long term, they still need some of our soybeans. As I mentioned earlier, 61% of soybean consumption that takes place in the world takes place in China. The Brazilians don't currently produce that much.
Gotcha.
China will need some of our soybeans. Ultimately, they want to buy the soybeans where they can get them at the best price point. And if we have a competitive price, we know that they want our product because it is a good quality soybean. It's a good economic value when there's not tariffs in place. And they will come because we give them value, but we have to give them value in the market. If we're out of touch where our price point is, they're going to look elsewhere. So we have to be price competitive and also provide a good quality product, which we have a history of doing.
Okay,
we just
right.
need the opportunity to do that once again.
Well, Caleb, before this current trade war, were there any barriers to you selling into China? In other words, isn't this, I think the argument has been on the part of the administration that we'll be better off after all of this ends. But you guys were fine before, right?
We were doing okay, and love them or hate them, the Chinese bring a lot of demand, and they need our soy protein to raise the meat protein that they feed their people. There's more pigs in China than the rest of the world combined, and they need our soy protein to feed their pork. They also need our soy protein for their poultry. That's the two main meat proteins that their people eat, and they have a huge appetite for that, and they need soy to feed them. They can't produce enough on their own, and the U.S. and Brazil are the two largest providers of that soy protein. We need to be competing in that market. It's a great opportunity for the American farmer. It's the largest ag export from the United States, and we need to be participating in that market as much as possible. It's a market that U.S. Soy has worked for nearly 50 years, getting that market segment established and growing that market and providing quality and providing consistency. And we have a reputation of bringing excellent quality soybeans to the Chinese market. They want our products. We just need to provide them at a price competitive point, and that's where the tariffs get in the way in the trade war.
Caleb, great to see you again. Thanks for checking in with us, and we'll talk to you again soon.
Thank you, Julie.
We got much more markets action coming up. You're watching Market Catalyst. Stay tuned.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And we do have the Dow now trading in the red, flipping into negative territory, down just around 0.1%. The NASDAQ leading the way higher, up 0.5%. The S&P up around 0.3%. So a bit of a mixed bag here as we look to maybe secure yet another record close for the S&P 500. And this comes on the heels of that OpenAI AMD deal. So to that point, I want to take a look at some of the sector action that we've been tracking this morning. We have AMD up a whopping 30% on the heels of that news. That's leading to some declines in shares of Nvidia, which are now down about 1% off of the lows of the session. We have Broadcom pretty much trading just above the flat line. Micron up 3%. TSMC up 4%. So movements all across the chip space this morning. And then finally, I want to take a quick check on Bitcoin prices because we are once again trading at record highs. Now, seasonally, October is a very strong month for Bitcoin, and there is an expectation that heading into the fourth quarter, we will continue to see gains. We are now firmly above $125,000 a coin. But then outside of seasonality, we have the fundamental bull case here as well, with more investors looking at tokenization, the stable coin adoption, momentum trade continuing there as well. And also the fact that we have some policy uncertainty out there. We're still in the midst of this government shutdown, and Bitcoin is being looked at as a safe haven. So always interesting to see when it trades as both a risk on play along with a potential safe haven there. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching AMC, Paramount Skydance, and Firefly Aerospace. First up, AMC getting a boost from Taylor Swift over the weekend after partnering with the artist for her new album. Joining us for more, Yahoo Finance's Brooke DePalma. The share's down a little bit lower though. Brooke, did you go? Did you see?
I did not see it,
Taylor?
but I do know multiple friends who did go.
Yeah.
So I am surprised to see the shares down. But if you take a look year to date or over the past year, AMC has not been performing. I mean, right now, as you can see, the stock price only about $3. So not even Taylor Swift could really pull this one out, I guess you could say. Year to date, the stock is down more than 25%. Over the past year, down more than 30%. But there was a lot of optimism around what exactly this Taylor Swift event brought to the theaters. On average, there was about $8,914 per theater across roughly 3,700 locations for this one weekend only event. And I know so many Swifties who went to the event, and this just speaks volumes to Taylor Swift's very calculated approach to sharing these sort of moments with her friends. And so to see AMC get a boost over the weekend from it, keep in mind, it was one weekend only, so not really a sustained impact. But if you look back to that Eras Tour movie, that made $261.7 million. And so the momentum's there, but investors don't think it's enough really.
Yeah, well, and I'm just seeing one estimate. So if it took in 33 million in ticket sales, I'm seeing one estimate for 35. So maybe missed some of the most optimistic estimates out there.
Right, it didn't come in as much as people got excited for.
Right.
Also, too, I think to get tickets, so was fairly difficult as well. So maybe there's that. But AMC right now has 6 holds, 1 buy, and 3 sells on the street, and so people sort of just waiting for this one. Of course, it got wrapped into that meme stock hype as well.
Sure, but I guess doesn't help in a sustained fashion to have a one-off like this. All right, let's talk about something else in the media business. Paramount Skydance, the company officially announcing that it is acquiring the online news site The Free Press and naming its founder, Barry Weiss, as editor-in-chief of CBS News. The share's little change. This was something that has been speculated upon for a little while now, but Weiss is a pretty controversial figure, so it's interesting that this is happening.
Yeah, I went into the Substack, of course, where the Free Press is, and the note that she put out today I thought was really interesting. There was a line in there that she had said where it says, personalities and influencers have overtaken 100-year-old journalism brands in only a few years. It's an exciting, fascinating moment. And that really sort of stuck with me because it's this traditional media company really taking in this perhaps controversial Substack, bringing it into the business, wanting that sort of change and to meet this current moment.
Right. Well, and the irony is in her saying that influencers and such, she is not
she's a traditional New York Times
op-ed writer.
Right.
She is not a reporter.
Right.
She is an opinion writer.
Right.
So it's unusual at the top of a hard news organization to have someone who is an opinion writer.
And she is going to be editor-in-chief, of CBS News, starting effectively today.
Right.
But Paramount has really been trying to navigate this changing media landscape. They obviously think this is the right move, maybe to bring in another audience. And
or to placate people in power. Who knows? We'll see how it works out. Finally, let's talk about Firefly Aerospace. It's announcing a deal to acquire SciTech for approximately $855 million in cash and stock. What's SciTech? It's an advanced national security technologies company, whatever that means. And so the shares are up 7%. It looks like investors are happy about that buy.
Yeah, but the year to date, let's be clear, take a step back. This stock has been down more than 58% over the past year as well, down 58%. And there's not much of coverage on the street. Right now, there's only 4 buys, 3 holds, and 0 sells. So only 7 analysts really covering this. But Jefferies did put out a note about a week ago based upon Firefly's Q2 results. They said they were on target with the revenue outlook as expected. They also said that they're seeing visibility boosted by a $1.3 billion backlog and building momentum. And so there's slowly been some momentum building in the stock, especially over the past not really, today there's such momentum, but it's certainly been under pressure year to date.
So TechCrunch says that this SciTech sells missile warning and tracking systems. So it's more on the defense side of the equation. So we'll see how it does.
How it plays out.
Yeah, thanks. Well, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Prospero.ai is an AI-powered investment platform that provides real-time market insights and stock recommendations using AI algorithms and machine learning. Yahoo Finance's Josh Lipton spoke to the company's CEO about how it works.
So listen, we talk a lot on the show about AI. It's already impacting sectors, markets, different industries. You obviously think it could really impact investing. Talk a bit about your app and how it works, George.
So I come from the institutional world, and I worked at my first hedge fund when I was 17, and even on the buy side, I felt pretty disadvantaged versus the larger guys. So I've worked in AI for 15 years now, and what I've really been focused on are like underlying market equations. And so a lot of what we do is just visualize what institutions are doing in real time, make it simplified for retail investors, and try to help anyone pick stocks like a pro. And not only do we have that, we have newsletters that basically teach portfolio management around the 10 signals that we built. And what we like to say is we can explain a stock completely with those 10 signals without really overwhelming people.
How does the AI, George, in simple terms, how does it actually work though? How's it picking stocks? Is it technicals, sentiment, fundamentals? Walk me through it.
All of the above, right? A lot of what we use AI for is organizing information and adjusting in real time. So we have foundational algorithms that will take something like net option sentiment, which is summarizing the short-term options markets, and we'll do things to intelligently tag what we call robotic signatures. So kind of like the opposite of an option sweep order. We're looking for methodical movements across many different strikes, across many different expirations. And then we're looking for a lot of behavior in volume, in open interest. And then we actually ask the AI, based on market conditions, to figure out how to weigh that stock and represent that signal on a given day. And that's all up to the AI and what it's learned based on the relationship between the market and the signals going back and then forward.
There are other AI trading platforms, George. What kind of makes you all different? What's the competitive advantage? Is it the algorithm? Is it the data sources?
So I think the primary thing that really makes us different is we're actually focused on intelligence that helps anyone have better outcomes. You know, a lot of these things are either building portfolios in an automated way or picking stocks. And, you know, I use all the same tools that everybody else. And if you ask like an LLM or if you ask GPT to rank stocks, what they'll often do is they'll give you the biggest upside stocks and they won't understand risk. And so what we're really trying to do is we're trying to filter down the information, take the best of AI in terms of how to interpret the information, elevate certain stocks based on those signals, and then teach people how to manage portfolios with those signals. Because what a lot of people will tell you, even at the best hedge funds, is that people are still using data to make better decisions than fully automated systems. So we are trying to empower retail investors in a very similar way.
And what's the app's performance like, George? Is it consistently outperforming the broad gauge?
I mean, what we do is we give people signals in the app, but you can go on Republic, we're running a crowd fund right now, and see the reviews. People using the signals have gotten great results. We've seen people, multiply their traders multiplying their results on a higher level by like 50%. We've seen people find 300, 400% gainers that they wouldn't have had otherwise. But to show people how to use it, we've been making newsletter picks that we give away for free for the last 4 years. Those picks have been beating the S&P by an average of 67%. It's a paper trading portfolio, but it's still very powerful. And we've done things like got into Meta at 170, we got into AppLovin at 112, we got into ASTS, I think for the first time when it was at 15. This is the AI showing signals that are elevating the stocks that tell us, wow, this has big potential based on especially where we see institutions betting in size in the options market.
So I got to ask you, what are the picks now?
The picks now, I mean, right now, some nuclear names, LEU and UUU are I'd say those are the strongest in the signals in terms of, what we see as potential. We also really like Baidu, Alibaba. Some of those Chinese stocks have been doing very, very well in our metrics recently, and we just added INOD. That just recently came up, big momentum in our system. And then if you kind of pull back, we love the qualitative story. They've got a unique position in the AI space. They're growing really, really fast. And what we do is what we tell our users to do, which is a lot of the times the signals flag these, and they flag them in, whether it be options momentum, sometimes it's, thesis built around, where analysts are trading combined with, or we're raising their estimates around those things. And it just we use these signals. Sometimes it's social sentiment, sometimes it's elevation in the dark pool. Those are just 10 of our different ones. And then we say, hey, I can see why this makes sense. And that's how we come to the names. That's how we have a lot of our biggest gainers. But a lot of the times it's like the signals, screaming that these are great opportunities, and we're just checking them.
Need a break from the AI trade? Healthcare and biotech just had their best week in about 3 years, a sign of life in an area that many investors have left for dead. Is it time for a comeback? That's what we're talking about on today's Stocks in Translation. Now, of the 11 S&P 500 sectors, healthcare performance is dead last over the past 3 years. Here's a chart from Todd Sohn at Strategas ETF Research that shows just how unloved poor healthcare has been, and that's in green. And it's been that way since this bull market began 3 years ago. And it's especially so when you compare it to the tech sector in white. We're talking $10 billion in net ETF outflows for healthcare versus about $40 billion in inflows for tech. And after an initial pop in late 22, healthcare has been a story of steady selling. Investors have thrown in the towel, according to Sohn. But if price keeps picking up, those outflows can reverse and fuel a catch-up trade. Here's another way of looking at healthcare's shrinking relevance. In this chart going back to 2011, also from Strategas, we're taking a look at its weight in the S&P 500 versus that of industrials and also the world's largest stock, Nvidia. Healthcare at the top in green has trended down over the last 3 years, while Nvidia at the bottom in white has rocketed higher. And you can see industrials in blue has just moved sideways since about 2020. That a single stock is nearly as big as two entire sectors tells you just how crowded the AI trade is. So diversification isn't a bad idea. Let's take a look at some reasons to consider healthcare. First, it trades with low beta, which is a measure of market sensitivity and lower volatility. So more on this in a minute. We also just mentioned diversification, especially important when the AI trade cools or just takes a backseat, as it has done a few times already in this bull market. And according to Strategas, healthcare tends to do better than the S&P 500 itself in years of midterm elections in the US, and that's 2026. And some crucial context. Ownership is thin after years of outflows. Not many investors are on board with the trade, which can lead to a game of catch-up if price continues to pick up. And admittedly, that could be a big if. Here's a direct comparison between the largest healthcare ETF, XLV, and the biggest semiconductor ETF, SOXX, which is based on the Philly Chip Index, the so-called SOX. We just mentioned market sensitivity, or beta, which is much higher in the chips. It tends to go hand in hand with volatility, and these measures cut both ways. You don't tend to get as many gut-wrenching spills, but you also have less potential upside. And you tend to get bigger dividends with many healthcare stocks. Chips just don't return as much cash flow to the shareholders. But this can vary quite a bit when you drill down into healthcare's many industries. If you do want higher beta and higher volatility, take a look at biotech or genomics ETFs. They might not pay big dividends, but they will have more potential upside and, of course, downside as well. Big pharmaceutical giants, they tend to pay bigger dividends. Finally, when it comes to valuation, like the famous price-to-equity ratio, chip stocks have a much higher multiple, which can be a warning. But I'd also add that valuations can stay stretched or also very low for years, so this is not a timing tool. And here's your quick reality check. Rule 1, price must stair-step higher. Higher highs, higher lows, that is the definition of an uptrend. If price does the opposite and goes lower, those outflows will only get bigger. Then remember that rallies can be uneven. It can be very difficult to time a bottom in an unloved sector. And keep in mind that some industries within healthcare, they look much better than others. As an example, equipment does not have nearly a good setup as biotech right now, which leads to the final point. Always understand what you're investing in. Stock and ETF selection matter greatly. Bottom line, the setup for healthcare is here. It's hated, it's under-owned, finally moving. But the trade needs to earn investor trust to turn around. As Alpha Trend's Brian Shannon likes to say, only price pays. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Over the past decade, total government debt among emerging markets has more than doubled to nearly $30 trillion. And according to an IMF study, the makeup of that debt, namely in the form of local currencies, can be integral to countries protecting themselves from what it calls global shocks. Joining me on set is Tobias Adrian, International Monetary Fund Financial Counselor and Director of the Monetary and Capital Markets Department. That's a mouthful of a title. You dug into this emerging market debt situation and did a deep analysis. What is the sort of top line takeaway of the implications of that ballooning of debt?
Yeah, let me make 3 quick points. So the first one is that major emerging markets have made a lot of progress in terms of developing local government debt markets. And that has made them more resilient. That's particularly so in countries that have also developed a buy side, so pension funds and insurance companies that are coming in when shocks are hitting the country. So the combination of having a local market, of having local buy side, and then combined with broader policy frameworks. So these are about central bank, monetary policy, and regulatory policy. You get to emerging markets that look very different from what we were used to 20 years ago.
Does that mean that something like an emerging market debt crisis becomes less likely?
So we have seen debt rise in emerging markets, but we have also seen debt rise in advanced economies. Right. So it's really a global phenomenon. So what we worry about is not emerging market debt in particular, but debt everywhere. So we see sovereign debt that has been rising, and we see that at the long end of the yield curve, right, the 30-year yields, they have been pushing up. So there is a certain concern there in markets.
So explain the concern in a little bit more detail to me. What is the concern? What are the risks here? What do we need to keep a watch for?
So at the moment, financial conditions are accommodative, right? So stock markets have rallied around the world. Corporate spreads and sovereign spreads are very, very tight. And of course, investors are pricing in a further easing of monetary policy in many countries around the world. But of course, adverse shocks can happen. We have seen that with the pandemic, with the war in Ukraine. We have seen the inflation shock. And then the question is, if asset prices were to sell off, what would that mean to countries that have high debt levels?
What's the likelihood of something like that happening? How do you sort of game that out?
I mean, these are tail risks, right? Mm-hmm. The central scenario is one that looks fairly robust. We're forecasting that growth continues and that inflation is coming back to target in countries around the world. But of course, financial markets are there to absorb shocks. And so we are thinking not just about the baseline, but also about the risks of the baseline around the baseline.
I'm also curious about the implications of all of this for not just the debt markets themselves, but for emerging market economies and emerging market stocks as well. Does it sort of make the whole system more sound and investable?
Absolutely. So we have seen emerging market equities rally this year. Spreads are very tight. So there's capital flowing into emerging markets. And that is making them more resilient, right? So having deep capital markets is absolutely a plus. So for countries that haven't gotten there yet, our advice is to develop those domestic capital markets.
I mean, all of this is sort of good news for you all at the IMF as well, right? Does that mean there's not less for you to do, but less sort of triage that you all have to do?
Well, the IMF really does 3 things. So one thing that we're well known for is help countries in acute crisis, right? And what you're alluding to is that hopefully there are less programs in the future because less countries are going to be in severe crisis. Hopefully we'll get there. The second thing that we do is really to provide hands-on help to countries to build their capacity, so to build their regulatory frameworks, their central banks, and develop their capital markets. And that is less visible, but it's very important for countries. The third thing we do is to assess countries. That is what is called surveillance. And our assessment in turn is helping countries guide them how to have better policy frameworks.
Tobias, thanks so much for coming in.
Great.
Good to talk to you.
Thank you.
And that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.